buy an appreciating asset that cash flows for you. You get fixed long-term rate debt. All you have to do is not mess it up. Just don't sell it, hold it over time, and it will work for you. Compounding always starts very, very slowly in the beginning. Relationships compound. Assets like that compound too. Welcome back to SEO Like the Best. I'm your host, Michael Chang. If it's your first time listening to the show, the key purpose of the podcast is to better help you invest both your time and your money. So if you're looking into short-term rentals and how it can be a part of your wealth building plan, you're in the right place. I have my special guest today, Ryan Bakke. Ryan and I have known each other for years now. Runs one of the most successful one of the most successful CPA firms in the country. And I love talking to Ryan because I always learn something new. And Ryan, welcome back to the show. You're one of my very few returning guests. So
I'm happy to be back.
So Ryan, maybe if you want to do a quick introduction for you and your firm.
My name is Ryan Bakke. I'm former Big Four accounting. I worked at Deloitte for a few years, and I decided that I wanted to not help every single person. I wanted to help the person in their family that was going to change their family tree. And so I left Deloitte to build my own accounting practice. Never knew how big it was going to get by any means. My first goal when I quit corporate America, I just wanted to be able to make $150,000 a year and work on my own schedule. And it grew into something bigger. And, fast forward a few years later, like we're hitting almost 8 figures in revenue and about 60 employees. So it's like crazy to see where it's come. I think marketing and podcasting and talking about a lot of these topics has always been one of my favorite things to do. So I'm glad and excited to help people in any way that I can.
Ryan was one of the first people I reached out to. We joke about this when I was researching the SCR tax loophole back in 2020 in the first version during the first Trump administration. I reached out to him on Twitter. We didn't know each other by then, and asked him a question. He was like, "Well, this is a good question, but I get these questions all the time. Are you serious about doing this?" And then that was our first interaction together. And that research phase for me was actually really important because that really laid the groundwork of how I built my portfolio today. If you're first time listening, we own 8 properties, 8 short-term rentals. We're a big user of the STR tax loophole. We think that the STR tax loophole, just to broadly define it, is you are able to buy a short-term rental, take bonus depreciation against that, and offset that depreciation expense against your active income. And you do that, and it's part of the tax code. There's certain things you have to do, which we're going to talk about today. If you are working, you're a high income professional, there are very, very few ways to reduce your taxes legally. This is one of those very few ways. It's only been back for a year with the One Big Beautiful Bill, and it's been a big topic. So, as the licensed tax professional here, not me trying to explain it, but maybe just broadly define the STR tax loophole for the listeners here, if you don't mind.
Yeah, for me, the real estate tax all started when I was working at my first accounting firm. I was doing 2 tax returns one day, and one tax return was for a married couple making $200,000 a year W-2. Another tax return was for a guy who owned a bunch of apartment buildings in Chicago. He paid less in taxes than the married couple. So I went to my boss and I was like, "Did I do this wrong? Am I going to get fired?" He's like, "No, it's because he's a real estate professional, or it's because he's a real estate investor." And I was like, "Huh, I have to learn everything that there is to know about this." So I started studying the real estate tax code, particularly the Section 469. And in those rules, there's a little carve out for, well, hey, if you have a property where you're renting it out on average 7 days or less, then it's not considered a rental property and it's not subject to those passive activity rules like a long-term rental or a multifamily building would be. And instead, it's actually treated as a business. And in order to deduct that business loss against your active income, you have to materially participate, which means you have to spend, a lot of working hours in the property, 100 hours and more than any other person, or you spend 500 hours total across all your properties. It's just so funny because it's just this little couple of sentences, maybe probably less than 300 characters, where there's the exceptions to the rule. But it's that little paragraph that sparked this whole thing over the last, I would say, 6-7 years, with the short-term rental loophole. And back in 2020 through 2023, people could put 10% down on a property, super low interest rate. They were getting more than their down payment back in the form of tax savings. And then we saw bonus depreciation start phasing out until the end of 2025 when they introduced the One Big Beautiful Bill that brought the 100% bonus depreciation back into resurgence. We started to see a spike in activity and people in demand for short-term rentals across the board.
Well, I hear a lot of confusion and people think that it's going to go away again. based on the tax, no one has a crystal ball, but based on the tax bill that was passed, is bonus depreciation going away or is this here permanently?
There's two things to think about. Number one is the actual code that's written that allows you to take a short-term rental loss against your active income, as well as what's propping that loss to get higher and higher. It's bonus depreciation, right? Like the short-term rental loophole, even with bonus depreciation phasing out or not even there at all, is still a strategy until they amend that part of the Internal Revenue Code.
Let's not give people ideas about what to do to close this off. But I think my question is here. I think there is a confusion in the market as the law is currently written. Does bonus depreciation go away? Does the 100% bonus depreciation go away? Does it sunset like it did?
It's permanent.
It's permanent, right?
Until maybe a new administration comes in, right?
Exactly. So it could be at least 2 to 4 years from now, maybe something changes. But right now, so to your point, so it's permanent. So 100% is permanent right now, it's currently written. And there's this exception to your point in the tax code where if you do the 100 hours, it's called the material participation requirement, 100 hours more than anyone else, 500 hours, you don't have that restriction. There's 5 other rules. Then this is a sustainable strategy that you can use going forward for years on until they potentially change it, but maybe they don't. And I think that's a critical point, at least for me, is as we speak to our clients, is some knew about it in 2020. Like we used it in 2020, 2021, 2022. You knew it was going to kind of go away because it's the way the tax law was written back in 2018. So it's like, okay, well, it's kind of nice for a few years, but it's going to be gone. But now it's permanent. So it just, it re-rates, in my view, at least, the assets here, the asset value of good short-term rentals. We were talking before, though, you built a huge practice now. Sure, you have a lot of kind of short-term rental investors. Are you seeing, more and more people interested in the topic, or is this something that, what are you seeing investors do with their portfolio? Just, kind of high-level comments, if you want to comment on that.
I think overall, the smart investors, at least the people that I've seen do this the longest, are starting to sell off some of their properties that they believe are kind of at peak prices, and they're trying to do that before any sense of like market decline. You and I both know it's really hard to predict prices of stuff will be in the years to come, but I would say a lot of the people that are selling right now they've definitely made a lot of profit.
Yeah.
They bought properties a couple of years ago, 3, 4, 5 years ago. They've already refinanced once or twice. And now they're like selling to kind of get cards off the table, either move into different asset classes or kind of diversify their portfolio.
One of my, a guy that we both know, which I won't name, he had like 7 properties. I think he sold almost all of them now. I wanted to bring that up because I think that's an important point is there's obviously a lot of, people talking about short-term rentals. Is it a good investment, bad investment? There's obviously different opinions. If you're sitting on a big gain and you want to take chips off the table, it makes sense. Everyone's everyone's different. What we're seeing is, or what I think the market might not be fully appreciating, is how powerful now the realization that this is a permanent tax strategy that high-income professionals can use to invest in real estate and also offset their taxes. And because I think the way that you can think about it now is it's not just a tax strategy, it's a real estate strategy, and there's a big tax component to it. And what I mean by that means, one, it's a deferral strategy. So if you end up selling it and get your money back, you got to pay all the depreciation back under depreciation recapture. It'd be a very painful process for that person that does that. So you want to hold this real estate for a long time. Maybe you turn 31 it, maybe you give it to your kids, basis step up, all that fun stuff. But fundamentally, you need to hold the asset. So you got to buy like a good property. It's going to cash flow for you, hopefully appreciate over time, and take that tax benefit. And I think that's where people that weren't in the market 2-3 years ago, they're realizing, they're like, oh, okay, I can actually own a house. Okay. There's no real way for me I'm a doctor. There's no real way for me to reduce my taxes legally. Oh, but I want to invest in real estate and I can take this tax benefit. Okay, this actually could be a good outcome for me. I think that's where maybe there's a disconnect in the market, but I think the market will eventually realize that. We'll kind of see what happens there. The market's efficient, right? It's going to adjust for that tax benefit, in my view.
Yeah, and I think to your point too is you have to go into it with a mindset of the tax benefit is like a cherry on the top to what I'm focused on doing. If I'm a high earning doctor, let's say, and I'm like in an operating room every single day, it's like when I stop being in an operating room, I stop making money. It's like, do you want to be in the operating room until you're 60 when you can finally pull out all your 401k and IRA money without a penalty? Probably not. So you start buying these rental properties and like getting the system set up so that they can start making money for you. I've had so many clients that were healthcare professionals, doctors that have been able to cut back hours, from 60, 65 hours a week down to 15 to 20 hours a week, spend more time with their family because they invested in real estate. And it's super powerful to see. But one of the things in there is, and you mentioned, is buying that cash flowing property. Because if you buy something solely for the tax benefits without really running the numbers or working with a coach or somebody like your team to make sure that they're actually buying an asset that's going to perform, what I see a lot is people are stuck in the same exact spot 2-3 years from buying the property with a losing horse, with a losing property. I had a lady that came to one of my boot camps back in, I want to say it was either late 23 or early 24. And she's like, man, if I would have listened to you guys about a year ago, you would have helped me prevent from making a big mistake. And I was like, well, what's that? And she's like, well, I bought this property. I had some doubts about it. I wasn't unsure, but it was going to save me $70,000 in taxes, $75,000, $80,000 in taxes. But she's like, the property loses $3,000 a month.
Jesus. Yeah. Oh my God.
And so you save 70 in year one, you're losing $3,000 a month. By the end of year two, you just lost what you got in tax savings, and now you're still stuck with the loser, right?
And the brain damage that's involved in dealing with that loser for 2 years. And it's awful.
Yeah,
you're right. Like, never let the tax tail wag the dog. That's the right formulation to have. Buying real estate, you want to do the work up front. Is it a good property, right? For some people, they don't really, maybe the cash flow is not, I don't think anyone really wants to go negative. Maybe cash flow isn't the biggest thing for you. You're a surgeon, you're making good money, you want a nice house, you care about the appreciation actually more than the cash flow. And that's perfectly fine. But I think there's people that like go in and don't do any work, and their realtor tells them, oh, hey, this is a good investment, you should buy it. And that realtor's not going to be there 2 years later. Like, you're the one holding the bag on that. So, make sure you're in the right market, right? The regulations are right. Make sure you actually underwrite the property, analyze it. Like, what's the revenue? What are expenses? What's your financing costs? What's your actual cash flow from that? And like, do that actual work, because you don't want to be like this lady and has a $3,000 a month loser. You're from Chicago, so you're from the Midwest. You'll appreciate this. I have a client that he's a chiropractor. It's a very successful practice. He's buying a property in Missouri now. And he was just like, yeah, man, like, my dad was a chiropractor. I'm a chiropractor. Last 30 years, my back hurts, my neck hurts. It's like, I can't keep doing this forever. Like, I got to, we have a nice business, but I got to figure out a way to create a different kind of wealth for myself, because doctors are, you guys, it's hard work. They make a lot of money, but it's hard work. A lot of training that goes into it. I want to kind of take a quick segue on a topic. You work with a lot of high income clients. What are like some, outside of STR tax loophole, what are some other strategies that you typically see across, the clients like they utilize?
First, it would probably start with what type of plans they have at work. So most people are going to have like a regular 401k that allows you to get your 24,000 plus in there every single year, like as a tax deferral. So if you're in those high tax brackets, that's pretty appeasing to you, because you get 35 or 37% deduction. There's some work plans that offer even above that, like post-tax contributions, where they're able to after-tax dollars into an account that kind of grows like a Roth forever. So like, those are kind of if your workplace allows for it, those are great to use and like start with, and figure out how you're going to kind of use those to your benefit. I think some people make the mistake of going way too much in 401ks or IRAs at work. Like, if you're somebody that's got $1.5 million, let's say you're like 40 and you got $1 million or $1.5 million in your 401k already, historically that's going to double every 8 years. So by the time you're 48, it's 2 million. By the time you're 56, it's 4 million. By the time you're 64, it's 8 million. At some point, you want to take your foot off the gas on the 401k stuff and start building accounts that will work for you faster, and also the liquidity that you can access the money. You go buy a short-term rental and it's cash flowing for you. You can access that money sooner, or refinance, whatever, or like a taxable brokerage account that you can contribute to, so that way you can actually retire before 59 and a half.
Yeah.
Oil and gas is a great strategy for people who are high income earners, because they don't really have to do much other than write a check. That carries risk and responsibility too, because you're not in control. It's the operating manager of the oil and gas syndication that is in control. And we've seen how up and down oil prices are right now.
Do you see that actually working? Like, I'm sure there are good cases or good results, but I've what I've heard is like you write the check, you get a good benefit, but then it's kind of like doesn't really do anything for you afterwards.
I've definitely had clients that work with people in the past that was definitely the case. Like the company that we refer out to, like they have a pretty good track, like they have a proven track record, you know, like decades of doing it. I always tell people like you want to invest in what you know and understand. You know, at the end of the day, like if it's too complicated or it seems like gibberish and you don't understand it, like don't invest into it.
No, I totally
don't let
agree.
that, you know, don't let the tax tail wag the dog. And at the end of the day, you'll come out ahead by making the money and paying the tax than if you didn't make the money at all. But like the tax code it's a huge part. I remember back in, this was probably end of 22, maybe end of 23. You know, one of our best clients is making $700,000 a year plus between him and his spouse. They already had a portfolio of short-term rental properties, and he's like, "Man, I really don't want to buy right now because interest rates are super high." You know, they were like 6.5 at the time, and I'm like, "Well, you know how to operate short-term rentals. You can like get these things to be profitable. Yeah, the interest rate's high, but what's your other opportunity?" You're in a 37% federal bracket. You're going to have net investment income tax. You're going to have state tax. You're in California. You're looking at 50% tax on any of that money that you keep. And it's like, yeah, I know the interest rate's high, but like your actual best thing to do right now is not to just hold on to that money because the government's going to take 50% of it. Like, you should go and buy more real estate because you're good at doing that. You know what I mean? If I'm working with somebody that has no properties yet, and they're like, I'm going to invest in real estate so I can save 50%, you know, off my tax bill. Different story. The other thing that people don't fully consider, because we saw a lot of people as that bonus depreciation started phasing out, like 23, 24, they were sitting on the sidelines with a lot of money. Well, the problem with sitting on cash is that number one, it gets taxed. So you get $100,000, you're in a 30% tax bracket, boom, you're left with 70. Okay. But then it's also the inflation that eats away at that dollar, right? So that purchasing power a year later, now that 70,000 can only get you $65,000 of goods and services, right?
Dude, have you seen that? Like, this is like eye opening for me. I saw this this study from which bank, like JP Morgan or something. $1 in 2025 is worth 70% of what it was in 2020 pre-COVID, like due to inflation and like the dollar losing purchasing power, like relative to other currencies. Your dollar, it could buy 70 cents of what it could have in 2020. That's crazy. So you're like, oh, hey, I made like, you know, if you're up 30% since 2020, it might feel good, but you've actually just broken even. Eggs are $5 now. They were like $2.50, $3 before. It's crazy. Going to San Francisco in a couple days, it's $850 per flight. You know, it's usually like a $500 ticket, $550 ticket maybe. And I know it's summer, but $850. I bought it like a month ago. If you don't invest that dollar, that hidden inflation tax eats away at you every single second. And that's not going to stop. It's not going to stop.
That's all these games that they're playing with us too, right? It's not just the, you know, the price of the Southwest airline ticket going up to $300, but also the quantity of stuff and the goods and services that you're getting now is lower. My wife and I went on a hike last week, and we walked into a gas station to get some Gatorades after. She's like, I want to get the one that has the little thing at the top that you screw off and drink. Like, you remember the old school like Gatorades?
Yeah.
I go in to find that, and it's like this tall.
Yeah.
I remember it being not 2 feet tall, but I remember it being like a lot more quantity. And I just got
inflation, man.
Sorry, I got so upset. But here's the thing about inflation.
Sorry, on that side, just like I noticed the same thing. Like when my wife, when Liz, she ordered DoorDash and, you know, Target to get us some like sparkling water, some LaCroix. It didn't occur to me, and I was like, wait, but there's actually only 8 cans in here. Let me get 12. It used to be 12 pack. Now they're just the little boxes. Yeah, it's still like $6, but you get 8, not 12. Like, you just lost like a third of it. You're paying the same price. It's all these these like mind games they're playing on you. You know, thank God for those guys at Arizona Iced Tea, man. They don't do that kind of stuff. So
or Costco, right?
Yeah, or Costco. Hey, still 99-cent pizza.
But here's the thing. It's like Warren Buffett said this, I believe. He said, like, compound was it Einstein? Maybe it was Einstein. Sorry. Those who understand it get it, and those who don't understand it pay it. I think it was Buffett that said that, right?
Yeah.
So how does inflation work to your advantage? Well, if I can buy a good property at a fixed rate mortgage,
dude,
right?
Yeah.
For 30 years, when I'm going to pay that money back, it's worth less, right? So I have that same mortgage payment over 30 years. When I'm going to pay that dollar back year over year over year, that dollar that I pay back is actually worth less.
And I hate when people play games on the adjust, get an arm and just like the 30-year fixed money. It's like the cheat code to wealth building. And you put 10, 20% down on a piece of real estate, borrow 80% fixed for 30 years. Nowhere else in the world can you do that. In business, I was an investment banker. No one lends you 30 money fixed rate. The only way to do that is because the government subsidizes it. So you have a business attached to that, a short-term rental. You get 30-year fixed money at an 80% LTV, you're 4Xing your initial equity. There's no better way to make money. If that sounds Greek to you, I'm sorry, let me try to reframe it. Someone's like Ryan said, you're borrowing money for 30 years, fixed rate, 6%, 6.5%, whatever it is, but that's forever. That's not going to change on you. They're letting you buy business asset. You're only putting 10, 15, 20% down. So you get to borrow 80% of that. And you have a business that cash flows, pays off the debt, appreciates over time. This is why I don't like the Turo model. Cars depreciate. You buy a brand new car right off the lot, 10% out, 2-3 years, 40%. Houses appreciate in value. Cars generally depreciate in value. Buy an appreciating asset that cash flows for you. You get fixed long-term rate debt. All you have to do is not mess it up. Just don't sell it, hold it over time, and it will work for you. Compounding always starts very, very slowly in the beginning. It's like a good marriage. Like in the beginning, or a relationship, it starts off slow. The longer and longer and longer. You and I have known each other for 7 years. Like you text me, hey, let's do a podcast. 2 days later, we'll hop on a podcast. Relationships compound. Assets like that compound too. And it's like, if there's one thing that you can take away from this conversation from both you and Ryan, is that fixed rate debt, good. Business assets, good. Cash flowing assets, good. Get more of those. Just sticking money in your 401k, it's great, but it's just a number on your phone that you can't touch for 20, 30 years. Like, how'd that money work for you? What other things do you kind of see people do? Because I don't want to just be like, okay, just STRs. Like you and I agree that it's a very positive thing, but maybe what else do people generally do? And maybe if you have a view on that, besides just 401k.
Have you heard of Remix?
No, what's that?
Okay. So there's like a secondary market where it's normally not available unless you know about it or you have like a financial advisor that has an in, but we're essentially able to buy like failed mortgages for commercial properties and get a tax write-off for it. So an example, we had a client that put a million, close to $1 million in to it and ended up getting a $4.5 million tax deduction. And if you're in a high enough tax bracket, you're putting in $1 million in, but you're getting 1.4, 1.5 million of tax benefits. But it's literally not an investment at all, because after the first year, that property's already gone. It's just you get that arbitrage on whatever your savings are. It's like it's a one-time thing. It's like, but it's in the tax code. It's in there. It's available for people who I would not even say like 37% bracket. I would say probably like your $1 million plus earners.
Yeah. Interesting. Okay.
Yeah,
cool. That's kind of different. Cool. Okay.
It's different than like a conservation easement or a land easement. Those kind of get pushed around a lot, and most of those that end up getting audited lose. But like the REMIC thing it's in the tax code. It's pretty detailed as far as what you are allowed and not allowed to do. And so like we've had a couple wealthier clients use those.
Alpha leak alert. Ryan Bakke, alpha leak alert. All right, that's cool. I like that. So if you make $1 million, ask your financial advisor or something like that you can access. You bring up a really good topic, and I know we're running a little short on time, but the audits, right? I think people. Let's talk to the STR tax loophole. I like to say the IRS doesn't audit the strategy; they audit documentation. So where do you see, you work with your clients that are maybe utilizing the strategy? Like, where are some things that you counsel on them that, hey, these are red flags that let's address now, so that you're not looking over your shoulders for 7 years and waiting for that letter in the mail.
I think the 7 days or less thing is pretty easily accomplished, considering if you're in a dominant Airbnb market, you're not doing any longer term stays. That one's super easy to verify. You can go on Airbnb, you can pull your transaction summary. You can get literally a list of all the guests that stayed at your property, when they checked in, when they checked out. An auditor is going to compare those to, Susie stayed at your property for 4 days. Show us the Susie's deposit. Now they all roll up into the same Stripe or PayPal account, obviously, but that's easy to track. I think where a lot of investors go wrong is two things. Number one, they don't have the proper material participation documents, or they build their log after the fact. So, we require our clients, if they want to use a loss against their active income, Like we require them to have a time log. There's been a couple cases where it's like, hey, we know you're good for it. We'll let you slide. It's not the CPA's job to actually determine whether or not you qualify or not. The taxpayer or the client signs the tax return under penalties of perjury. But we do a really good job of making sure that our clients will qualify. If you do get the audit letter, I feel comfortable like defending you because I was the one, or like our team looked at your time log and was like, yeah, this person qualifies. The other thing I think is having a good story as to why you decided to get into real estate in the first place. In the first interview that you have with an auditor, they ask you so many questions as far as where did you go to college? How long have you been married? Like all these like personal questions. And I asked an auditor about a year and a half ago, I said, why do you guys ask all these questions? And she said it's because they want to know whether or not you're likely to fall for a tax scam or not. That's why they ask about your education level, your career, etc. Well, if you go in there and tell them like, yeah, I wanted to buy this short-term rental because I heard this guy with blue eyes on Instagram talk about how much I could save money on taxes, you're probably going to lose that. But if you go into it with like, yeah, I'm a surgeon, I'm working in an operating room a ton, like my hands are giving out on me, and I stumbled across this short-term, like my wife and I stayed at a property and we loved it. We wanted to do it ourselves. So I got the property running, and then I, stumbled upon this part of the tax code that allows me to, take the tax benefit. It's like all about the story that you kind of.
I haven't heard that angle before, but yeah, no, that's a good point. Like why are you doing it, and like kind of showing them that you did the work. I think your point on the log is extremely important. I think that's where we believe the biggest risk on that is your log. Like they don't really understand what it is, and they're like, oh, okay, 100 hours, all right, it's fine. I'll figure it out later. Or two is like they do it after the fact after they get the letter, which is like an easy way to fail. It's probably like 99% failure rate. I don't know the number, but a very, very high failure rate. And two is they don't actually document it consistently, or they're putting the wrong thing on there. You can document it any way you want. You can do a spreadsheet. You can use a pen and paper. You can use crayons. You can do like whatever you want, right? I mean, I'm joking on the crayons, but as long as you're doing it consistently, you have proof, right? If they're reasonable, they follow what is allowed and what is not allowed. Like travel time is not allowed, for example. Research time is not allowed, for example. There's obviously other rules, and I'll let the licensed CPA talk about it, not me. If you're going to do this strategy, take it seriously. Make sure if you're doing a 100-hour rule, you and your spouse are logging it together. You're keeping track of other people working for you. Make sure you have their hours and document it consistently and have it readily available. If you got to keep these records for 7 years, so have it in a place where if you get asked for it 3 years from now, you can just go back and find it and deliver it to your CPA or whoever's defending on the audit. An app is a great idea. We developed an app called STR Tax Loophole. So if folks are looking for something like that, go on our website, www.thestrtaxloophole. We've seen solutions out there that we frankly didn't think were made specifically for STRs. They were maybe made for real estate professionals. Being able to pull in all the phone data that you have, all your emails, using AI to track it. All there are specific workflows for STRs that we think are important to build into an app or to build into your log. So that's something that you're interested in. Please take a look. Fundamentally, I think it's this: if you're going to do this tax strategy, I think one is find the right CPA that actually understands this. If your CPA is putting short-term rentals on Schedule C, turn around and run the other way, because then that's the wrong approach. But I think one, find the right professionals to help you. And two, if you're going to do it, buy the right property, right? Make sure you're actually doing work to buy the right property so that it actually is a good investment for you. And three is just make sure that you document everything appropriately. If you have those three things, the right team, the right property, the right documentation, you're in a good spot. It'll be a good asset for you. Hopefully it'll appreciate. Hopefully you got that 30-year mortgage. Take advantage of the depreciating dollar. Have something that you can pass on to. And, if you're a high-income professional and maybe you made a lot of money and you want to take a step back in your 50s, enjoy time with your spouse, with your kids, have some other assets that are cash flowing for you. Your cash flow is not solely dependent on the amount of time that you put in your job, right? You have other things that are working for you as part of your portfolio. That's my take.
I mean, most people default to what our parents did. Well, what did our parents do? They worked for 40, 45 years. They had a 401k or a pension, and when they retired, they looked at, here's what I have in my home, here's what I have in my 401k. Maybe I'll draw Social Security in a couple of years. But we're in like this new era where everybody, like I think a lot of people say like younger generation doesn't want to work harder. I think people want to work the hardest as possible to get out of the corporate rat race, or to get out, like to not have to work till 60. Like the entire, like, you work till you're 60 and you retire, that was all like propagated by the government, basically. You see people where, how do you get your life to where it becomes like work optional? You got to do it by investing in assets.
You got to do. Yeah, I'm so aligned with that. The propaganda that like you need to work till you're 65 and you're old and tired. That's when your life starts. It's absolutely ridiculous. If you can break out of that mindset, like that's such a big first step. And the second one is obviously like, okay, well then how do I get work optional? Right? Well, you need to build financial assets, right? You need to have enough money to do that. You can only work so hard. We're limited 24 hours a day. You got to sleep. You're working 16 hours a day. That time, like that time doesn't scale. What actually scales is business assets, things that actually are going to work for you independently of your time. So real estate, other businesses, stocks, whatever that is, like that's what you have to kind of think through and build for yourself. And hopefully you have enough of those and they're performing that they can cover your income and give you more optionality of what you want to do. It's not like people don't want to work. They just want to do things that they actually want to do and not just be stuck, in a job that maybe they don't want to do 60, they don't want to do surgery 60 hours. They want to do 20 hours and spend time doing something else, right? If you can pull from that lesson, this episode, you're ahead of the game. I think for folks, if they're looking to contact you, to reach out to your team, what's the best way for them to reach out?
They can find me on all social media platforms at Ryan Bakke CPA, or you can find us online at taxstrategy365.com. And then I also have a school group. It's skool.com/taxes.
All right. Well, I'm part of that school group. So folks, that's a great group to join. Also part of your Facebook group. Ryan's been very generous with his time and his knowledge. So Ryan, appreciate what you do for everyone. And folks, we'll have it in the show notes for you guys to reach out to Ryan and his team.
Thank you so much.
If you enjoyed this episode, please like or subscribe, Apple Podcasts, Spotify. If you enjoyed this episode and you have a friend or a spouse that you think would benefit from this, please share that with them. And if you liked what you heard today, or have any questions, please leave a comment. And so I read all those comments and I'll respond, and we'll give us more ideas for new topics on the show. Everyone, thank you very much. Have a great day. Bye now.